If you're building a long-term portfolio, there's a good chance the S&P 500 is at the core of your strategy. It's the benchmark that most investors measure themselves against, and for good reason. Today, we're breaking down IVV, the iShares Core S&P 500 ETF, one of the most popular ways to get broad U.S. stock market exposure. We'll cover how it works, how it compares to other S&P 500 funds, and why the details actually matter even when you're buying something as straightforward as an index fund. Let's get into it. So what exactly is IVV? At its core, this fund tracks the S&P 500 index, which is a collection of approximately 500 of the largest publicly traded companies in the United States. When you buy shares of IVV, you're essentially buying a small piece of every company in that index, weighted by their market capitalization. That means the biggest companies like Apple, Microsoft, Amazon, and NVIDIA make up a larger portion of your investment, while smaller companies in the index have less impact on your returns. Now here's something a lot of investors don't realize about the S&P 500. It's not a purely mechanical index. There's actually a committee at S&P that decides which companies get included and which ones don't. They have criteria around market cap, liquidity, and profitability, but they also have discretion to exclude specific companies even if they technically meet the requirements. This means the S&P 500 isn't just a passive list of the 500 largest U.S. stocks. There's a human element involved in the selection process. Does this matter in practice? For most investors, not really. The index still provides outstanding coverage of the U.S. large-cap market, and the committee's decisions don't dramatically change the overall composition. But it's worth understanding that when you buy an S&P 500 fund, you're not getting a purely rules-based index. You're getting a committee-selected representation of the U.S. economy. One thing that makes IVV slightly different from a pure large-cap fund is that the S&P 500 actually reaches a bit farther down the market cap spectrum than you might expect. It includes some mid-cap stocks along with the large caps. This means IVV tilts slightly smaller than some other large-cap benchmarks. Again, this distinction is essentially academic for most investors. The analytics show that it doesn't meaningfully change the risk or return profile of the fund. But if you're the type of person who likes to understand exactly what you own, it's a detail worth knowing. Let's talk about why you might choose IVV specifically over other S&P 500 options. The two biggest competitors are SPY, the SPDR S&P 500 ETF Trust, and VOO, the Vanguard S&P 500 ETF. All three funds track the same index. All three have extremely low expense ratios. All three will give you virtually identical returns over time. So why does it matter which one you pick? The answer comes down to structure, and this is where IVV has some advantages for certain investors. IVV is structured as a 1940 Act fund, which refers to the Investment Company Act of 1940. This is the same structure used by most mutual funds and many ETFs. SPY, on the other hand, is structured as a unit investment trust, which is an older structure with some quirks. One of the key differences is dividend reinvestment. With IVV's 1940 Act structure, dividends can be automatically reinvested when they're paid. With SPY's unit investment trust structure, dividends must be held in cash until they're distributed to shareholders. This creates a small cash drag on SPY's performance during rising markets. We're talking about a tiny difference, maybe a few basis points per year, but over decades of compounding, it can add up. Another advantage of IVV is transparency. The fund discloses its holdings daily, so you always know exactly what you own. Some other fund structures don't provide this level of transparency, which can matter if you're trying to manage tax loss, harvesting, or avoid overlap with other positions in your portfolio. IVV also tends to have a slightly lower expense ratio than SPY. As of recent data, IVV charges around 0.03% annually, while SPY charges around 0.09%. That's a difference of 6 basis points, which translates to about 60 cents per year on a $1,000 investment. Not life-changing, but when you're choosing between essentially identical products, why pay more? Now, SPY does have one advantage: liquidity. It's the most heavily traded ETF in the world, with massive daily volume and extremely tight bid-ask spreads. For institutional traders moving millions of dollars, this liquidity matters. For individual investors buying and holding for the long term, it's largely irrelevant. IVV has plenty of liquidity for normal-sized trades. VOO from Vanguard is structured similarly to IVV and offers comparable expense ratios. The choice between IVV and VOO often comes down to which brokerage you use and personal preference. Both are excellent options for long-term investors. Let's zoom out and talk about why the S&P 500 in general is such a popular choice for portfolio construction. The S&P 500 represents approximately 80% of the total U.S. stock market by capitalization. When you own the companies that drive the American economy. You get exposure to every major sector: technology, healthcare, financials, consumer goods, energy, industrials, and more. You get automatic rebalancing as companies grow and shrink. And you get the benefit of passive management, which means low costs and no manager risk. Historically, the S&P 500 has delivered average annual returns around 10% over the long term, though of course past performance doesn't guarantee future results. The index has survived world wars, recessions, financial crises, pandemics, and every other challenge thrown at it. It's not that the S&P 500 is magic. It's that owning a diversified basket of the largest, most profitable companies in the world's largest economy has been a remarkably effective wealth-building strategy. That said, owning only the S&P 500 does mean you're concentrated in U.S. large-cap stocks. You're missing out on small-cap stocks, international developed markets, and emerging markets. A truly diversified portfolio might include exposure to these other asset classes as well. But as a core holding, the S&P 500 is hard to beat. One more thing to consider is tax efficiency. IVV is highly tax efficient for an equity fund. The ETF structure allows for in-kind redemptions, which minimizes capital gains distributions. This means you're not getting hit with unexpected tax bills just for holding the fund. You control when you realize gains by choosing when to sell. So who should consider IVV? If you're a beginner investor looking for a simple one-fund solution for U.S. stock exposure, IVV is an excellent choice. You get instant diversification across 500 companies with a single purchase. If you're a long-term buy-and-hold investor, IVV's 1940 Act structure and dividend reinvestment capabilities make it slightly more efficient than some alternatives. If you're cost-conscious and want to minimize expenses, IVV's rock-bottom expense ratio means more of your money stays invested. And if you're building a more complex portfolio with multiple asset classes, IVV makes an outstanding core U.S. large-cap position that you can complement with other funds. The bottom line on IVV: this is one of the best ways to invest in the S&P 500. The fund offers outstanding coverage of U.S. large and mid-cap stocks, a favorable structure for long-term investors, daily transparency into holdings, and one of the lowest expense ratios in the industry. The minor distinctions between IVV, SPY, and VOO are largely academic for most investors, but if you're optimizing for long-term buy-and-hold investing, IVV checks all the boxes. If you found this breakdown helpful, make sure to subscribe to the ETF Investor and hit that notification bell so you don't miss future deep dives. Drop a comment below and let me know what ETF you want me to cover next. Thanks for watching, and I'll see you in the next one.